Hello everyone and welcome back for another market update on the S&P 500. Today I'd like to start out with a belief that I think is absolutely crucial when it comes to trading, which is don't look for too much, rather look for the right things. So what are the right things? In my opinion, they definitely are. First of all, what is the higher time frame context of your trading? Secondly, what is the sentiment going around? And thirdly, what are correlations with respect to the assets you are trading? Before we jump right in, some personal words. Sorry for there having been some silence of roughly 2 weeks, but hey, the baby is here. Yoo-hoo! The dad of 2 now, back to the charts, and I tell you, more determined to reach financial freedom than ever before. Even so, apparently my time has shrunk down again. But now let's jump right in, and as always, let's get started on the higher time frame, meaning the monthly chart here in front of us of the S&P 500. The main thing you first of all want to work out obviously is what does price action tell us? Where are AOIs? I call them areas of interest in the chart. For that, as always, let's throw on our monthly levels. And here we can then clearly see that either this, what we are currently looking at, is shaping out to be a monthly deviation above this monthly trend turns bullish level at around $4,130, then we'd be looking at a bigger pullback or a massive fake out, one of the two, or we are simply still range bound between these two levels, roughly 4,200 to the upside and 4,060, 4,050 to the downside, marked out basically by the liquidity resting above the February high and below the last month's low of April, which we have already run one time. To get a better read on that, we would have to zoom in a little bit, but before we do that, let's also throw on our monthly levels. And there we see that, yes, we do know that we are in an area of heavy resistance with battling with this target box, bearish target box from this leg starting in April down to our current monthly low that we formed in October. And we still haven't hit our bullish target box starting at around $4,051, which I still have my eye on for the moment. Hiding our levels one more time and zooming into the weekly, what do we then see? I've hinted at it already. The lower time frames point to there rather being more downside, and thus this being a deviation. Why? Simply because at minimum we have been forming a weekly trend shift. Yes, the bigger picture weekly uptrend is still intact. Nonetheless, we formed a weekly higher low here before a new high, and we have officially on a closing basis broken it already last week, and currently as we speak seem to be unable to get above it again. However, the week has just started, so let's throw on our weekly levels, see whether we want to add anything here. Still weekly liquidity above us that we did go for but didn't quite reach. And if we also put on our levels boxes, and then we see that indeed there is quite some reason for why this weekly trend shift may turn into a bigger pullback to fill in some of this weekly liquidity starting at around 4,010, and again weekly fair value gap starting at around 3,965. Both of these fair value gaps line up nicely with weekly target boxes. As you can see, one taken from this swing point, and the other one, the first one, taken from the low at around $3,900. Will we still get this final push up before then the bigger push down that we've talked about time and time again? I wouldn't rule it out. However, looking at the chart and its current state at the moment, I think it is rather less likely. Nonetheless, trading is always for preparing, so should price get to this level, be prepared to try and sell it on the lower time frames. Finally, for the weekly, let's see whether the monthly can give us more confluence. And indeed, we have this first monthly target box starting at around 4,052. In other words, below weekly liquidity and just above our weekly fair value gap. So why not spike this box into this fair value gap for a push up again? And obviously we could do the same with respect to monthly levels. And here we have this monthly swing point lying at around $3,970, which lines up nicely with our target box. Target boxes down here on the weekly. Then obviously let's zoom into the daily as well. And what do we see here on the daily? At best, we see a chop fest, I would call it. We are, it seems, range bound, chopping up both ends of the range. Let's try and define this range a little bit. For example, if we take this high here as a potential range high, which then we would have to say we haven't interacted with yet. Also of interest could be this low down here, which has acted as resistance several times and now apparently as support. Another area of interest would potentially be the level of around 4,100. We've just mentioned it when we were talking about the charts on the weekly. Now, these levels seem to make sense. However, they are also highly subjective. So what can you do to maybe give your analysis some more consistency with respect to range borders and more objectivity, so to speak? Here I'd like to use my cheat sheet. If you've watched any of my videos before, you may already know about it. It's the here shaded in darker gray Bollinger Band squeeze, and we had another one here. But if you just look at the last two squeezes, you'll see what I mean. Yeah, we have this high, which lines up nicely. If we take this squeeze, we have this low, which lines up nicely. Same over here. So overall, we are roughly potentially looking at this whole area shaded in gray, I would say. Let's change the colors here. A bit darker is better. And to the upside, we can play the same game. And we would then potentially look at this area marking a potential range high. As you can see, it's not just a level, it's rather zones, which line up very nicely with the levels that we had marked out earlier on. So basically what I want to stress here is the following. Getting rid of our cheat sheet again. To me personally, what I think the situation is at the moment, we are still caught within this range, and I could see us chopping around a bit more before we either decisively break up or break down. Which one is everybody's guess? That's why I'm saying the daily for me is a bit choppy at the moment. If you want to trade it, you should definitely focus on the extremities of the range and either long somewhere down here if you can get a trigger on the lower time frames, or sell up here if you can, for example, get a deviation or any other kind of trigger on the lower time frames. With all of that in mind, let's then move on to the next thing we want to analyze. If we have gained a higher time frame context, let's look at the current sentiment. For that, we can first of all have a closer look here at this chart. Again, you see the S&P on the 500 on the weekly, and you may remember this question. If you've seen my latest live stream, you know about it and what I believe. Sell in May, go away. Is this a myth or is it the truth? Well, the data shows that actually more Mays in the last 25 years have been bullish than bearish. Nonetheless, what you can also see here, I marked it out already for you, and I talked about it in my last stream. Click on the link to find out more about it. These red lines mark out yearly midpoints. So this basically is the midpoint of the yearly range from 2021, and here at around 4,150, the midpoint of the yearly range 2022. So basically taken from our absolute high in 2022 down to our absolute low. Let me adjust it a little bit so you can clearly see it, and bams, right smack in the middle you find this midpoint. And what backtesting and looking at past data shows is that whenever you reach this area, be it as support or be it as resistance, you get strong reactions. Example here in April of last year. Again, same example in May of last year, end of May, deviating above it in August, again rejection in January this year. And so the question is, are we deviating above it again? Well, this is where you can make use of your second piece of confluence potentially, which is the fear and greed index, the SCNN, fear and greed index. And what do you see? Well, we are in the greedy zone. Ideally, I'd like this indicator to go into the extreme greed area, which we haven't tagged yet, but nonetheless, you see, taking all of this together and remembering that on the weekly time frame, we said we are witnessing at the moment a weekly market structure shift at minimum. We want to be rather cautious, obviously, with respect to longing, and we should definitely rather focus shorts this week and over the next coming of weeks actually. If you like such clear and simple analyses, then support me and the channel. I give my time and my knowledge. You maybe give a like and subscribe. That would be wonderful. Thanks for everyone who has already subscribed and become part of the community, and everyone else who still wants to become part. Let's grow as a community together. Well then, I would finally like to come to the last part of my analysis here today, which is correlations, and looking at the S&P 500, and potentially having already watched some of my videos, you know which correlation I'm hinting at. Yes, the DXY. So let's open the DXY chart here. We've said it time and time again, the DXY and the stock market are inversely correlated. So in other words, if the DXY has a tendency to go up, then you can expect the S&P to go down. Obviously, you need to combine that with resistance and support areas, and this is exactly what we have here. We have just broken market structure, at least shifted it on the weekly, on the DXY. We have bounced, or we are currently bouncing from this weekly fair value gap at around 101. And if you have a closer look, where should price be headed to on the DXY? Well, you see this weekly fair value gap starting at around 103.25, and you have another fair value gap starting at around 104 roughly, lining up nicely with a weekly bearish and monthly bearish target box. In other words, you should absolutely expect price to try and get up there before potentially pulling back again. And what does that obviously then mean for the S&P? Yes, you guessed it. Be it today or be it over the next couple of weeks, you should rather expect the S&P 500 to pull back from this heavy resistance area that we are currently battling with, if you look here at on the weekly chart. So summing up the longer to midterm view, what can we say? First of all, we are at heavy resistance, and all of that after a sizable rally up. Secondly, witnessing at least a weekly trend shift is a fact and doesn't speak out for too much more upside. Thirdly, the sentiment is greedy, and more downside, potential downside, works well with the main narrative, be it true or not. And finally, we are looking at a proven DXY correlation and a DXY that is potentially lining up for more upside at the moment. So yes, putting my name here on the line. If you are trading the mid to higher to longer term trend, then you should definitely rather prepare for taking a short over the next couple of days or even 1 or 2 weeks than longing into this heavy resistance. Nonetheless, all good and well if you know that, but if you have little capital and you want to grow your rather small trading account, as many of us want to, then you can't only rely on the higher time frames, because they can take forever to play out. What you want to be able to do is take profitable and highly probable setups on the lower time frames as well. And if you wonder on how to do that, then watch the video I link for you here now. And until then, I say thanks for watching and see you soon, guys. Bye bye.